Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Kevin Carter, founder of EMQQ Global. We're talking about investing in technology and e-commerce companies in emerging markets and China in particular. Kevin, welcome back to the podcast.
Thanks for having me. Good to be here.
So I wanted to start with your thoughts on Jack Ma's return to China because it is being seen as such a significant event for Chinese tech companies. Ma, who is arguably the most prominent, or one of the most prominent Chinese billionaires, he returned to China after more than a year-long absence, and that had come after he gave a speech criticizing Chinese regulators. We know that Ant Group's high-profile IPO was cancelled. Alibaba was raided by Chinese regulator, and a hefty fine was slapped on Alibaba. And this regulatory crackdown on Alibaba and other tech giants that resulted in loss of more than 1 trillion in market value by these technology companies. So tell us what his return to China mean at the time when the Chinese government is trying to reassure private businesses that private sector is still welcome in the country.
My short answer is yes, it should reinforce people's feelings, especially towards the internet companies and the series of regulatory events that you referenced. And, there's been 2 hard years for Chinese internet companies and emerging market internet companies more broadly. And as you pointed out, the beginning of those 2 difficult years was the cancellation of the Ant Group IPO, which was going to be the largest IPO ever. And as you also referenced, a lot of people thought that the reason they canceled the IPO was because Jack Ma had made some comments about the regulators and the regulations that were sort of a sarcastic, take on the situation by Jack. And people said, "Oh, they canceled the IPO because Jack Ma made these statements," and then further that Jack Ma was in fact quote unquote missing. And when I looked at the situation, I didn't see it as the way others did. And that's one of the things I've realized about China is people are so afraid of the Chinese government. They think it's evil and that they don't believe in capitalism and that they're mad at Jack Ma. They're going to take over his company. And I think these are far-fetched things that I think are headlines and coverage of the situation, reinforces in people's minds. The reality is most people have never been to China and they don't really have much of an understanding of how the place operates. And in the particular case of the Ant Group IPO, the reason it was going to be the biggest IPO ever is because it was a gusher of profits. It had huge profit margins, huge scale. It was growing very fast. But most of the profits were coming from lending. They were originating loans on their 2 credit platforms and creating a huge amount of consumer credit that was growing at an incredible rate. And they were not being regulated like a bank, nor were they keeping the risk on their own books. And so the government was going to change the regulations for, I think, reasonable reasons. And if they had waited to after the IPO and made those regulatory changes, the company's profitability was going to decline and it would have been a bigger problem. So in fact, I thought it was actually a good move to stop the IPO. Now, the papers didn't report it that way. They said Jack Ma is missing. And so that was the beginning of all of these other fears and the fines you referenced, which again, if you look at the US tech companies, they're paying fines all the time for different things. And the idea that, Alibaba and Tencent had been using anti-competitive tactics in their growth is really indisputable. I mean, I'm a fan of these companies, but there's nobody can say that they didn't do the sort of anti-competitive things they did as they went through their incredible growth and basically took over every part of consumption, from healthcare to entertainment to food and groceries, and finally financial services. And they did that by taking advantage of their size and strength, and as did Tencent. And so the regulators brought them in and said, look, we have these rules. You need to play by the rules, and we're going to fine you all. And collectively, they paid $30 billion in fines, and Alibaba itself paid about $3 billion, but they had $80 billion of cash. So, I mean, this wasn't like a horrendous, painful fine. And, if you look at the amount of fines that people like Google pay in Europe, it's got to be multiples of that amount. So on an annual basis. So I don't characterize any of what China did as a crackdown. I mean, it certainly felt like it, and the reaction from investors was such. But I think most of it was just reasonable efforts to regulate these tech platforms that have grown very fast, not just in China, but in the United States and elsewhere. And regulators have, had trouble keeping up with them. And I don't think there's any problem with healthy regulation. But Jack Ma's return perhaps signals an end of that 2-week or that 2-year-long, quote unquote crackdown. But even before Jack returned, the Chinese government had been very vocal, including Xi Jinping himself, that China is not out to kill their technology companies. China is not out to crush Jack Ma or Alibaba. They support these companies. They know these are important companies, and this is where the growth has been for the country and the job creation has been in the country. So I think that it was a good, hopefully, bookend to the Jack Ma is missing a couple of years of pain in the stocks, but I think just a fear after fear that American investors had about the Chinese government and how they really operate.
That's very interesting. It seems that you were not a fan of Ant Group's IPO. So I wanted to ask you about Alibaba's recent restructuring announcement that came after Ma's return. And they are now looking to split the company into 6 business units. And there's a possibility of these units IPOs. So the company said that this initiative is designed to unlock shareholder value. So what are your thoughts on the reorganization? And Alibaba also announced its own chatbot, which would be a sort of competitor to ChatGPT. And we know how good ChatGPT has been for Microsoft's share price. So what are your thoughts on the chatbot and the reorganization?
Well, first of all, let me just clarify something on the Ant Group IPO. I was, Ant Group is a fantastic business and was, as mentioned, one of the most profitable and valuable companies on the planet before the regulators changed some of the rules and they stopped the IPO. I wasn't against the IPO. I frankly was concerned about the IPO because of the A-share listing. They were going to do half of the IPO in Shanghai and half in Hong Kong. And as you likely know, there's no way to sort of hedge the difference in those prices. So you have this disparity in valuations, which is a challenge for indexing. But moving on to where we are today. So I think that the idea of Alibaba breaking up into its different units is a great idea. And in fact, back when the regulators did their antitrust reviews, starting 2 years ago, that was one of the things that seemed like it was clearly on the table. I mean, you have, essentially 2 companies that are somewhat monopolistic, and that perhaps one of the remedies the Chinese government would take would be to, in fact, force them to break up. Now, they didn't do that, and now it looks like perhaps in a nod in that direction, and also in an era now where focusing on profitability and tightening up the operations is happening all over the planet for different reasons. I think it makes a lot of sense. I mean, we don't have a lot of historic case study for what happens when you dismantle a company like this, but And to the extent there are examples, it's not really clear that any of them are easily, transferred in thinking about how Alibaba might be broken up. But it is, I think, likely to be a net positive both for the businesses and then importantly for the share prices. I mean, these companies have been very cheap. They've been very out of favor. They've been sitting on a lot of cash, and I think that that letting them operate with more autonomy that almost has to lead to them being more nimble and more focused on the task at hand for each of the individual business without the whatever level of bureaucracy might exist in the current company structure.
So China had very strict COVID-related lockdowns. The country was under those lockdowns for about 3 years, and it is now reopening. So what does that mean for e-commerce in China? Because obviously when people were under those lockdowns, maybe they were ordering food online and buying stuff online. And after staying at home for 3 years, everyone would be interested to go to the restaurants and go to the malls. And during this period of lockdown, the Chinese economy suffered a lot, actually, and consumer spending also suffered. So what does reopening mean now for the outlook of e-commerce in China?
Well, let me first say this. I mean, one of the, if we go back to the beginning of the COVID, actually China was the first COVID was pretty successful in extinguishing it and keeping it out. And they were able to largely stay online and not locked down while the West was locked down. And they were able to keep the factories open and so forth. But then when the second COVID came, when the Omicron came, whether it was because of the Olympics or otherwise, it was going to get there. We had experienced that ourselves, even here being vaccinated. And so it was really the last year is when the real lockdowns happened in China. And as you know, I mean, one of the most incredible turns in modern history, the Chinese people took to the streets in December and said, we don't want to do this anymore. And the protesters were out and were not seemingly afraid to shout out and call out Xi Jinping himself and be videotaped doing that. And in an incredible turn, like literally the next day, the Chinese government said, fine. And they literally dismantled the entire apparatus for testing and so forth and said, let's just let it happen. And so now remember, that was only a few months ago, right? That was 4 months ago now, or 4.5 months ago. So now China's come through that and they are back. And I think, it'll take some time to see what new equilibriums sort of develop in terms of consumption. But e-commerce, in China is way bigger than any place else on the planet. I mean, that's one thing I don't think people totally realize is that, China might be an emerging market in a traditional sense, but when it comes to e-commerce, when it comes to smartphones and so forth, China is the most developed country on the planet by a mile. And its e-commerce market is 4 times bigger than every other frontier and emerging market combined. So the growth rate in e-commerce in China cannot be as fast as it can be in places like India, going forward.
Yes, I agree with you on the outlook for e-commerce in China. But one of the main concerns that I have with Chinese companies, particularly these technology giants, is the recent US crackdown on these Chinese companies, because we know that the two parties here in the US agree on almost nothing, but this issue has bipartisan support. Both parties want to rein in the power of these Chinese technology giants and also counter China's technological advances. So what do you think about US regulatory crackdown on China?
Well, I mean, let me first speak to another part of the fear that drove these things down over the last couple of years. In addition to the regulatory issues, you had the U.S. threat to delist these companies, and that issue was unfortunately that may have caused a lot more damage to investor sentiment than did the actual regulatory issues. And because people were afraid, they didn't understand what delisting meant. Even professional investors somehow didn't quite understand that if you own a share of something, it doesn't matter what stock exchange it's on, and or if it's even on a stock exchange, frankly, that you don't lose all of your money because a company gets delisted. But the idea in people's minds was that that's exactly what happened, that they were going to wake up one day and their Alibaba stock would be worthless. And now that was, I tried to explain to people that was silly, but more importantly, that the odds of them actually delisting these companies was infinitesimal, in my opinion. I mean, it was a bunch of hot air, and it seemed almost certain that the Chinese would agree to accept the PCAOB ability to review the audits once they got the state-owned enterprises off of the New York Stock Exchange, which is why we didn't enforce our own rule for 20 years. And so they moved their state-owned oil companies and banks back to Hong Kong listings, and that cleared the way for them to resolve this silly, politically driven spat. And the regulators, finally the PCAOB, which, by the way, the accounting watchdog had all of their executives and board members fired during all this time. So the Chinese didn't have anybody to talk to for about 8 months until they finally put in new leadership for the PCAOB. But once they did, they got together in Hong Kong. They did their first audit reviews. They came home early and said that they had gotten full access. And so that part of the U.S. attack on Chinese quote unquote technology companies is behind us. The headlines haven't caused as much relief as the scares did on the way down, but that's something people shouldn't be worried about either. And then in terms of the hard technology, the semiconductors and those types of things, I mean, we don't invest in those, but I don't like it. I think that it's not free market, and when we're telling Dutch companies that they shouldn't sell hardware to Chinese manufacturers that, by the way, make electronic products for us more than anyone else, when we're going to tell the other countries not to do business with China, I think it's a terrible precedent, and I wish somehow we wouldn't be going that direction. But I don't control it. And as you pointed out earlier, the one thing that every politician agrees to, whether they believe it or not, but politically, I don't think I've seen a politician stand up and say anything positive about China in 10 years. So that's an unfortunate part of the story, and we'll see where it goes.
So let's talk about your ETF now. Tell us about EMQQ ETF and some of its top holdings.
Well, EMQQ is the Emerging Markets, Internet, and E-commerce ETF. So basically, what we invest in are, the China and India and Brazil and Africa version of Amazon or Facebook or Google. So the FANG stocks, if you will. And so this is about 125 publicly traded internet companies. And the reason that we think this is the best way for investors to approach emerging markets is really several fold. But first and foremost, the problem with traditional emerging markets investing in the indexes and ETFs that have really done nothing and gone almost nowhere in terms of performance for 15 years. The biggest problem with them is that they're full of these legacy economy companies. Most of them, or at least the largest of them, are mostly government-owned banks and oil companies. And so these are Chinese state-owned banks that are, they're not there to serve investors in a traditional sense. They are prone to make loans to companies that may not be creditworthy because they don't want layoffs. And then you also just have outright corruption. The best example of that is the Brazilian oil company Petrobras, which was systematically looted of billions of dollars by about a third of their congresspeople and maybe even two of the last presidents. So what the problem with emerging markets, the investing, is that no one's made any money because the companies that dominate the index aren't trying to do that. And so what investors should be focused on, and what I've been focused on for the 18 years that I've been dedicated to emerging markets, is tapping into the consumer, right? Because that's really the story. You have billions of people, 85% of the world's people, and they're younger than us. So it's actually 90% of the people under the age of 30. So even more of the future. And they want stuff. They want more and better food, clothing. They want appliances. They want to go to movies and take vacations. They want to get a vehicle, and they want their kids to go to college. And this is a huge deal. McKinsey calls it the biggest growth opportunity in the history of capitalism. So this is what investors should be focused on. And what I identified about 9 years ago was something big that was starting to happen. And it started in China first. Well, it started in the United States first, but then in emerging markets, it started in China first. And it was a combination of basically three megatrends. The first megatrend was the rise of the consumer. The second thing that I saw happening 9 years ago was the smartphone. Now, I had a computer for 20 years before I had a smartphone, so my use of technology has been very evolutionary. But what I was seeing in China was people were getting a smartphone, and it, in fact, was their first computer. And then once they also got that new computer, supercomputer in their pocket, if you will, which, by the way, most of these are not Apple devices. These are $100 Android-based smartphones. And those billions of new consumers were starting to also get the internet for the first time. And because they don't have bank accounts and there's no Target stores and car ownership is low, these billions of consumers are leapfrogging traditional consumption and are even more digital than we are, and skipping the bank account and going to digital payments. And so that's the thesis behind the story. I believe it's the fastest growing sector in the world, the emerging markets e-commerce companies. And in China, we own, as discussed, companies like Alibaba, Tencent, the other super app of China, JD.com, which is a business that looks a lot more like Amazon than Alibaba does, actually. So those are some of the China names. But the China story has dominated EMQQ so far. It's been the biggest part of our portfolio and the largest part of the revenue. We look through at the holdings, but there's a third internet wave coming. The U.S. was the first, consumer internet wave starting around the year 2000. About 2005 started the China consumer internet wave. And right now, the other 5.5 billion people in emerging markets outside of China, including India specifically, those billions of people are just now getting that first computer, that first smartphone, and getting online for the first time. So this third wave of growth is coming, and the next 15 years in South Asia, Southeast Asia, in South America, other parts of Africa, and the Middle East, there's going to be a huge amount of growth in digital consumption over the next 2 decades.
So you mentioned growth of e-commerce in India, and EMQQ does have exposure to India as well. But then you recently launched an ETF, INQQ, which is focused on Indian internet and e-commerce companies. And I understand that you just got back from a trip to India and Bangladesh. So I was interested in learning more about the e-commerce market in India. I know India has been digitizing at a rapid pace over the past few years. So tell us more about the growth of e-commerce in India and INQQ.
Well, we launched INQQ earlier this year. Now we had anticipated launching it because the India story is sort of unique within the EMQQ story, and we simply were waiting until there was enough public companies from India in the internet space. So, as little as 3 years ago, we only had 2 Indian holdings. There was only 2 public Indian internet companies, but there were a lot of IPOs in 2020, 2021. And so we finally had enough companies to launch INQQ. There's now 22 or actually 24 public internet companies in India that we own. And the case for India is quite compelling. It is the largest part of this third wave of the internet. And it has so many things going for it. When you look at India, it's hard not to think that there's going to be a lot of growth. First of all, you have what is now or soon to be, like, i.e. this year, according to the people that count, India is going to be larger than China in terms of its population. And India's population is very young. China, for many reasons, including the one-child policy, has a demographic that looks more like a developed country. India has the largest Gen Z population on the planet by a lot. And so it's not only a big country, but it's a young country. It has a swelling middle class. It has the fastest growing major economy. It has the fastest growing e-commerce market, just ahead of Brazil. And finally, and very importantly, it has a government that, first of all, is a democracy, which some people think is a better system. And the person that's leading that democracy for the last 2 terms and likely for one more, Modi, is all in on digitization and has really done everything he can to advance the country in a digital way. And it's worked. First, the Aadhaar ID system, and then the UPI payments interface, and perhaps now the just being piloted ONDC program. These things have all paid great dividends. And the UPI program in particular, I mean, one of the things that you see on the street in India now is that everybody is paying with their phones, and it's all QR code based, as it has been in China for a while. And the UPI system, again, which is the payments platform that the government cooperative developed, it has cut basically all friction out of transferring money from one person to another. So you can, make transactions for 9 or 10 cents without any real cost, even. Not that that's an average purchase price of anything, but it literally is almost frictionless. And so that accelerating factor in the economy, I mean, you can see it. And so the India story looks good. The smartphone penetration rates are still pretty low. You have only about 450 or 500 million smartphones, but you've got 1.4 billion people. Now, you've got 1 billion people are using the internet, but you have families that are sharing a phone. And so, who knows how many brothers and sisters are going to fight today about who used all the data watching YouTube videos, but soon enough, all of them will have a $50 or even less brand new supercomputer in their pocket. And they have the lowest data cost, by the way, as well, which is another reason they're so heavy in using their phones.
Yeah, India is a very exciting growth story, particularly in the e-commerce area. And you mentioned that India is the fastest growing major economy now. And I had noticed that IMF just this week, they released their global growth forecast, and they expect India to grow at Indian GDP to grow at 5.9% this year and 6.3% next fiscal year. Again, the fastest growing major economy. So looking at INQQ. I see some very, very interesting companies. So I wanted you to talk a little bit about some of the companies within INQQ that you find very promising.
I would start with Reliance Industries because that's, I think, the largest holding right now, and it's certainly the largest market cap company, and it's a very important company, and it's one that needs a little explanation. It's a third generation family controlled conglomerate that started in basic industries like petrochemicals and textiles, and really grew into a conglomerate with significant holdings in retail and entertainment and so forth. And they made a pretty bold push beginning about 7 or 8 years ago to participate in the digital revolution that they saw coming. And the first and largest thing that they did in that direction was they launched the first 3G network in the country. And when they did that, they essentially gave away a trial period for data and promised to have the lowest cost data amongst the highly fragmented, at least at that time, the highly fragmented carrier industry in India. And that platform, the Geo network, has gone on to amass about 500 million subscribers. So just as the smartphones were starting to get in the hands of the Indian consumer, Geo was there to capture their cell phone or mobile phone service, and that has grown into a huge business. And one of the things that's unique, things are unique everywhere versus other places, and certainly versus the United States. But in the United States, the small shops and the mom and pops, they've been sort of eliminated and also in a lot of places, the distribution infrastructure for e-commerce and other commerce isn't really that well developed. And so the retail locations, like physical retail locations, can become a big asset in terms of distribution. And because Reliance has a network of over 20,000 actual physical locations, those can be levered to help with distribution. And then further, as part of their GeoMart effort, they raised one of the largest venture rounds ever, I'm sure. And right when the COVID started, they raised $30 billion for in a round of funding for the Geo platform. And the investors included Google and Facebook. And that, I think, really set the stage for them to try to build the super app of India. And it's still early, but they seem very well positioned to succeed. And the other thing that you have going on that's of note and importance in India is that the Indian regulators are, and the government has made it pretty clear that they want a playing field that favors the Indian homegrown internet companies. They do not want the Silicon Valley to own the digital India space. And so now some of these platforms, Facebook and so forth, and Meta platforms and WhatsApp have gotten pretty good penetration, but the government's put in market share limitations on certain financial, online digital financial products and so forth. So we'll see. It's still very early, but Reliance Geo looks like the best position, and it's also just a great way to get exposure to India as a country. They've got a lot of businesses. They own hotels. The hotel we stayed at was owned by Reliance, and they also provide the app-based system that the hotel workers use to manage, the operation. So they're really in everything, and that's a very important company, and we'll likely see Reliance spin off and or IPO some of the digital divisions that I mentioned. The other company that I think is likely to do very well over the long term is Paytm, which it shows up as 197 Communications that's how they're formally filed, but the ticker is PAYTM in India. That's also the brand name of their payments platform, which is the leading payments platform. And the thing that you see in emerging markets, and we certainly saw this in China, is that when e-commerce first began and people were getting deliveries but didn't have bank accounts, you had delivery drivers that were taking cash. And this wasn't that long ago. And so very quickly what happens is the e-commerce or the ride-hailing companies, they develop a payments platform to facilitate the commerce. And then that payments platform becomes a standalone business itself, because once you get the money on the phone, that payments on the phone, you need that for e-commerce, but then you become the bank for these new smartphone users. And once you have their money there, you can sell them insurance products, you can sell them investment products, you can do lending and banking services. And this has happened all over the world. And this is something that American investors don't realize. But imagine if not only did you buy everything at Amazon and watch your videos on Amazon, but what if you had your checking account at Amazon and had a car loan that you originated on Amazon and owned ETFs in your Amazon brokerage account? This is happening in the rest of the world where the traditional banking didn't exist or was so old and expensive and with state ownership that customer service was dismal. And so the fintech part of this story in India is enormous, and all of emerging markets, and Paytm, a leader there. And then another company we met with, which I think is just in an area that's certain to see growth, is a company called Nykaa, which is spelled Nykaa. And this is an online beauty company. They also have now physical locations as well, but it's sort of a primarily online, women's beauty products. And the statistics, when you look at it, the amount of money that the average Indian woman spends on beauty products is incredibly low versus peers in pretty much every other part of the world that's more developed. So the numbers are going the right direction. So I think they have a lot of growth. And what I also like about Nike is this, the founder story. Most of these internet companies in emerging markets are started by a young founder that went to Harvard or Stanford. They came from India or Brazil or China or wherever, and they go to our best colleges, and then they work for Google or Microsoft or Apple, and then they go back and get their MBAs, and then they go home, in their late 20s and start these companies. Well, this woman, the founder of Nykaa, was working as an investment banker and had, early on in her life promised herself she would be an entrepreneur one day, and all of a sudden she's approaching 50 and she hasn't done what she had promised herself. And so she quits her investment banking job and starts this online beauty site, and it turned her into the second self-made woman billionaire in the country. So that's another interesting kind of niche online market. And then there's another business we met with, and it's just a pretty simple, straightforward business, but it's called India Mart, and it's a B2B e-commerce company, and it's profitable and it has great margins. And I look at the income statement; it's exactly the kind of business I like. High gross margins lead to high operating and net margins, and they have very high margins from the top to the bottom. So those are a few of the ones that might be of interest to investors.
Right. These are all very exciting, very interesting companies. Reliance is like everywhere in all areas in India. Paytm, almost everyone uses Paytm to make payments in India. And I understand Paytm is Warren Buffett's only Indian investment. And even Alibaba, Jack Ma had invested in Paytm. And Nika also is a very interesting growth story founded by Falguni Nair, the self-made billionaire, as you mentioned. All very interesting companies. Now, switching gears a little bit, I wanted to talk about the role of these ETFs in an investor's portfolio. So obviously, these have a lot of growth potential, but they will be more volatile than broader emerging market ETFs, say EEM. So tell us about the role of these ETFs in an investor's portfolio. Do you advise your clients to have a small exposure to these ETFs or to replace their international or emerging market exposure with these products?
Well, first, let me say, as a disclaimer, this is a very volatile group of companies, and we've had many significant declines. We've had significant advances as well, but we've had multiple declines, and frankly, right now, we've had the last 2 calendar years we were down 30% each year. So, and from our top to our bottom, that the lowest price we had last year, we were down 80%. So this has definitely been a volatile area, but I would note that the last 2 years have been very negative on the negative volatility. Perhaps some positive volatility will return at some point, but so it's definitely volatile. And in terms of how to use it, I look, I'm obviously biased. This is my life, and this is the only investment strategy that we have, and it's the only thing I invest in. If investors want growth in their portfolio, I think that there will, I don't know of any other sector that is that has grown as fast as this and is likely to grow as fast as this. And so investors that have a long-term time horizon, 5 years at least, I think is the way to think of it. That doesn't mean you can't make money in a time frame shorter than that. And I don't know, when the stock market's going to go up or down, and I don't think anyone else does either. But I think the fundamental growth is here. I think it is again. I think it's the fastest growing sector on the planet, and should be for a while. And the stocks, the valuations are reasonable, and so I think if you have an appropriate time frame, if you've got 20 years, or if you're in your 30s or 20s, you should absolutely buy some of this. I think this sector, and just put it away and add to it, and because that's the one thing that investors, I think lots of them understand, but they don't totally appreciate, is how important the miracle of compounding is. And if you make a decent return, a decent annual return of any percentage above 10, and you do that for a decade or 2 decades, the numbers add up fast. And right now I think that the revenue growth in the sector is about 20%. And in some pockets of it, like India, perhaps even higher. And I think that you've still got 3 billion more people in emerging markets that don't even have a smartphone yet. And in India alone right now, you've got about 8 million people a month getting a smartphone, the first smartphone they've owned. And as far as I know, I don't know a single person who used to have a smartphone. So this is a one-directional growth story, I believe. And investors, if you can stomach the volatility and you have the appropriate long-term outlook, I think, you'll be glad that you owned some of this sector if you look back in a decade.
Excellent stuff, Kevin. Thank you so much for joining us today and for sharing your insights.
Thank you again for having me.
That was Kevin Carter, founder of EMQQ Global. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcasts. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.